In this video, we're going to explain why making money from the non-farm payrolls report has absolutely nothing to do with the calendar release itself. Hi guys, it's Aaron here from Forex Source, and before we begin, don't forget to subscribe and follow us below so that you're notified when we release a new video. Now, if you trade currencies, then it's almost certain that you've heard of the famous non-farm payroll report, or NFP for short. Now, this is an employment figure or number that is released on a monthly basis in the United States. Now, the reason it's so famous is because in general, professional traders watch this report more closely than any other data point in a monthly basis. Now, it gives them clues about the health, the overall health of the US labor market and the overall health of the US economy. Now, they then use those clues and those data to speculate on whether or not the Federal Reserve Bank, or Fed for short, will increase or decrease the United States interest rates. Now, this speculation causes some crazy price moves, as I'm sure you guys have seen, and it's only natural that retail traders see all of this going on and they also want a piece of the action. However, there is a really common mistake that most amateur traders make when it comes to trading the NFP release, and this also applies to any other data release as well. The mistake they make is to focus all of their attention on the numbers themselves. You see, every single data point on an economic calendar comes with something called a forecast reading. Now, this forecast is essentially a prediction from traders, economists, market experts and analysts on how they think the next data point will print. Now, from these predictions and forecasts, a median forecast number is derived, and this basically becomes the basis for the market's expectations for any data point that is coming out. Now, the general idea from here is that if the actual number comes out and is different from the forecasted number, the price will move accordingly, whether that is up or down. So, for example, let's say the NFP, the actual number comes out and is much better than forecast. The currency is normally expected to rally. And if it comes out much weaker, then the currency should generally fall. Now, most retail traders watch the calendar very carefully, and when the data comes out, they trade in line with those general principles. Now, the big problem with this approach most times is that it simply doesn't work. And this isn't because news is unpredictable or it's dangerous like some people say. It's only because those traders are missing one crucial ingredient. Now, this one crucial ingredient is something called market sentiment. Now, market sentiment is basically just the mood of the markets at any given time, how they feel about the future, whether it's certainty or uncertainty. Now, you might have heard on the news about market panics or bullish markets or bearish markets. Now, these emotions are really real, and the market is constantly switching moods on a daily basis. Now, if you want to really make money with something like the NFP numbers, you first need to understand what mood the market is in regarding the US dollar. So this will basically dictate how they are likely to react to any data point that is released, whether positive or negative. Let's look at a quick example, right? Imagine if NFP comes out better than expected or better than the forecast, but the market is in a really depressed mood about the US economy at that time. Now, this might be because all the other data has been terrible and the Fed looks likely to cut interest rates no matter what happens. Now, in that specific type of scenario, a positive NFP number would be drowned out by the overriding negative sentiment on the US dollar. And it's very likely that the markets will react to that positive number by actually selling the US dollar instead of buying the US dollar. Now, the rationale here would be something along the lines of the Fed will still cut and the economy is still headed towards a recession, even though this was a positive number. Now, those bigger picture worries will trump any short-term positivity in the actual number of the NFP. However, if in that specific scenario the actual number provided a very big negative deviation, then this will very likely cause a much bigger than expected sell-off in the US dollar because the markets are already negative on the US dollar at that time. So the reason that this would feed right into those market fears is traders are already negative, So it isn't going to take much bad news to get those sell-offs going again on the US dollar. So the next time you're thinking about trading the NFP, remember to first find out what is the current sentiment around the US dollar at that time. And then only jump into the market with any trades if there is a significant deviation, positive or negative, but that deviation is in line with the prevailing mood of the markets on the US dollar at that time. And that's basically the secret to making money from NFP and basically any other major data points on the economic calendar. So guys, if you found this video helpful, please do us a favor by clicking the like and the share button, leave a comment, ask us a question. It really helps YouTube to suggest more of our content. Until the next video, cheers.